In the 1600s, the Dutch East India Company operated a massive global trade network. They employed hundreds of ships to transport gold, porcelain, spices, and silks across the ocean. But outfitting a fleet this size was staggeringly expensive. To pay for these voyages, the company turned to private citizens. Individuals could hand over their own money to support a ship's journey, and in return, they would receive a percentage of whatever profits that ship brought back. By selling these shares to investors in local shipping ports and coffee houses across the continent, the company unknowingly invented the world's first stock market. From its inception, the market was created as a mechanical solution to a very practical business problem. It was simply a tool to collect funds and scale operations beyond the limits of any single individual's personal wealth. Today, the process of buying a share in a company is significantly more complicated than outfitting a physical shipping trip. Modern trading happens constantly across massive, dedicated global networks. Buying stocks still makes an investor a partial owner of a physical business. But if that underlying business is real, we have to ask why the value of that ownership fluctuates wildly based on rumors and daily news cycles. The price of a stock rarely moves entirely in sync with the quality of the company's product. Instead, modern valuation happens where physical corporate performance collides with human psychology. To understand what is actually happening when the market fluctuates, we have to separate the mechanics of running a business from the emotional behavior of the investing crowd. Let's imagine a new coffee company that wants to expand its operations but needs to raise the capital to do it. They can do this by sponsoring an initial public offering, or IPO. This is the mechanism that officially launches the company onto the public market, allowing anyone who thinks the business will be profitable to buy a stock and become a partial owner. The cash generated from those initial stock purchases is funneled directly back into the business, helping the company afford expansion and fund new initiatives. The baseline success of this operation is dictated by unavoidable physical forces. The company has to navigate the fluctuating price of raw coffee beans, invest in newer roasting technology, and pay the shifting costs of employee labor. These variables dictate the reality of the business's balance sheet. However, a strong balance sheet does not strictly dictate what the public decides the company's stock is worth. Once those shares are out in the public sphere, they operate on a secondary market. Here, the primary driver of value is a seesaw of supply and demand, based entirely on investor perception. If our coffee company appears successful, prospective buyers see potential and want in. As demand increases, the price of the available stock goes up, inflating the overall wealth of the people who already own shares. The inverse is equally true. If investors get anxious over bad publicity, an unexpected change in leadership, or new trade policies, they will try to sell off their stocks to secure a profit before things get worse. This chart illustrates the math of panic selling. As investors dump their shares, supply floods the market while demand evaporates. With no buyers willing to step in, the share price plummets. During a slide like this, the stock price detaches completely from the amount of coffee the company is actually selling. Instead, the number becomes a pure reflection of collective investor anxiety. This reveals a strange paradox built into the system. Merely appearing to lose value is often enough to make investors leave. And when that confidence vanishes, a self-fulfilling prophecy takes hold. The stampede for the exits drains the company of capital, turning the perception of failure into actual, tangible losses in market value. This phenomenon isn't limited to a single business. When the same anxiety ripples through thousands of different stocks simultaneously, it can freeze the flow of capital across the entire world, turning a bad afternoon on the trading floor into a multi-year economic downturn. The constant day-to-day noise of the market rarely provides an accurate reading of underlying business health. It acts more like a highly volatile thermometer for measuring collective human emotion. Because of this unpredictability, financial professionals strongly warn against treating the market as a place to try and make quick cash. Trying to outsmart the emotional swings of the crowd is incredibly difficult. While trading was once restricted to a professional elite, the historic shift to online platforms during the late 1990s finally gave everyday retail investors a seat at the table. Now, someone with a home computer can move funds and support businesses in the exact same ways a large institution would. Today, the most reliable long-term strategy requires patience. Experts recommend first educating yourself on the core operations of a business, finding companies you genuinely believe in, and committing to reliable, long-term investments. The stock market remains a deeply psychological feedback loop and constantly swinging between optimism and fear. But by understanding the mechanics beneath the noise, anyone can navigate the chaos and pursue their own financial goals.